So we stopped in this last lesson, which was classifying stakeholders. And we actually explained this. I'll just make a very quick thing that we have three types of stakeholders. We call them internal, connected, and external. Internal were your sources of human resource, like employees and management. Connected stakeholders are sources of finance, your investors, shareholders, customers, suppliers, creditors, providers of finance. And then you have external stakeholder, the government and public pressure groups, community, etc. And we learned in last lesson that first there was a shareholder theory, then there was a stakeholder theory, and then there is the agency thing. Shareholder was a very narrow term. Shareholder means people who invest money in the business. Stakeholders is a much wider group. Stakeholder means anyone, any party whose interests are impacted by the decisions a business take, or whose interests are impacted by the activities of the business. So anybody could be or would be the shareholder which has some relationship with the organization. And we need to understand that sometimes, and we said that one of the role of the management is to, how to say, create a balance, because organization has to meet the objectives. And when we say meet the objectives, objectives of whom? Objectives of shareholders? The answer is no, objectives of the stakeholders. So as the management, the management role is to make sure that the organization, through its activities, should try or will try to achieve the objectives of the stakeholders. And stakeholders, they might have conflicting objectives. For example, employees, they say we need higher salaries. Customers, they say we need better quality. Shareholders, they say that we need more dividends or more profits. And sometimes these objectives are in conflict with each other. Because let's suppose that if you decide to provide bonuses or increments in salaries to employees, so it means that employees, their objectives will be met, they will be happy. But then this increase in salary will cause reduction in profit, because that's an extra expense. So it means that employees will be happy, but shareholders objectives might not be met, they will be unhappy because their profits, they go down. Similarly, customers, they want better quality. So in order to improve the quality, your cost probably goes up. Cost goes up, profit goes down. Again, there is a conflict. So it is quite normal that while meeting the needs of one group of stakeholders, you have to make a compromise on or with the other group. And this is where the management's role comes in, that they need to create a fine balance in which they want to keep everyone happy, but still you cannot meet everyone happy. So what you need to understand is that which shareholders are more important for me, which shareholders I should be giving priority to their objectives, because you cannot put everyone in this in the same line. So you find out the relative importance and or the relative priority of different group of stakeholders, and then you start focusing on that which group, whose needs are top priority for me, whom I cannot ignore and who I cannot be, kind of put on the sideline. So for this purpose, we have this model, which is called Mendelow's model, and we call it stakeholder mapping. So in stakeholder mapping model, what we see that what they do here, that we have the interest on one axis. So this is one axis, which we call level of interest. And this is your second axis, which we call power. So power could be low, power could be high, interest could be low, interest could be high. So some stakeholders which are here in the quadrant D, it means that interest is high and it means that power is high. So these are those stakeholders who have huge power in the business because of their voting rights. It could be your institutional investors. It could be your major investors. And they also have huge interest in the business because their money is involved. So these are the one which are your top priority, you cannot ignore. On the other hand, if you see this segment B, here level of interest is high, but power is less. You see, power is less, interest is high. If you see section C, here you have interest is C, power is high. Which one would I consider here? Probably many government organizations or government departments, or probably the tax authority. They have low interest because you pay taxes, but they do not depend only on your taxes. So for them, interest is less, but they've got huge power. They can, really create difficulties for your business, the tax department. Then you have got this segment A where level of interest is less and power is also less. So these are the ones which are on your last priority. So you need to find out your stakeholder groups and you put them into different quadrants. And then you, according to them, for example, we say meet the needs. For them, you must meet objectives. You cannot ignore to meet their objectives. For them, you also have to consider and consider and keep informed. You cannot how to say ignore them. And by the way, you should remember that it is possible that the ones who are in B, they can move to C as well, or those who are in C, they can move to D as well. So this stakeholder mapping is not something a static position. Sometimes shareholders, they keep on changing the position. For example, a minority shareholder which probably having less interest somewhere here, they buy more shares and they move to high interest. And same could happen with this one. Somebody who is already in D, they might move to B. So stakeholder mapping is not a static thing, but it is a very clear understanding that you find out who are my stakeholders. Okay, I give you an example. We know that employees are here. Okay, employees. Okay, now, we all know that organizations, they depend a lot on employees. And if you see, I have been focusing throughout, like in last 5, 6 lectures, employees, 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 and employees. I always focused a lot on that. Now, probably I can say that I'm changing my position. I mean, for all three lessons, I say employees are my top priority, top priority, top priority. I understand. I'm still convinced. But not always employees are your top priority. There are some nature of businesses in which employees, they are very important stakeholder. And in some other businesses, they are relatively less. For example, if you are a consulting firm or if you are an audit firm, let's suppose, I'm sure all of you people have heard about Big Four or some other consulting firms. They are not manufacturing businesses. They depend a lot on human capital. Their audit managers, their audit team leaders, their audit experts, or their consultants. These are the people who actually run their business. If you consider like any company, like I have seen this like in Big Four, even in Big Four in one country, you know what happened? This was, let me give you a name. Let's suppose PwC. This was Deloitte. And what happened that one partner of PwC and two audit managers of PwC together moved to Deloitte. And when they moved to Deloitte, they took all the clients from PwC to Deloitte. Not all, but a lot of clients. And PwC suddenly, in that particular country, got a big blow because clients were associated with this partner and clients were associated with these two managers. And they convinced the client that, okay, we are going to Deloitte and you also come to Deloitte. It happens. It happens in advertising as well. So in some businesses, employees are very crucial because the business is actually, it depends on not on the entire organization, but depend on a lot on the few individuals. So in those businesses, your employees, they have got huge power. Employees are here. Huge power. Interest might be low, power is huge. But if now you consider a cement manufacturing plant, in a cement manufacturing plant or probably some other heavy industry which is a lot of heavy mechanical production or manufacturing industry, and you've got 5,000 workers working there. Now these 5,000 workers together, they have got power, and probably if the law allows trade unions, they might have a lot of power. But individually, these workers individually probably are do not have any power at all. They can be replaced very easily. I mean, if even if you have 5,000 employees, 10 employees will go, 10 you will bring in. And these are the people who work on the machines. So your business model does not depend on employee. Your business model in that particular case, in a cement business, is more dependent on the technology which you have installed, the machine capacity which you have installed. So some businesses are more dependent on technology or probably more dependent on machinery. Some businesses are more dependent on skilled labor, or uh, for example, if you speak about universities, schools, colleges, teachers, they play very important role. You cannot ignore their importance. But if you speak about manufacturing business like textile, you have 3,000 individuals working there. Employees, they become relatively less important. So, like I said, that if we only speak about word employee, so you need to understand what is my business model, and in my business model, what is the role of employees? Are they, I mean, do they exist in this high power area, or do they exist in this low power area? And based on that, your treatment will depend. If you are a director in a cement factory, you are treating your employees differently. If you are a director in a consulting firm where you have 10 consultants who handle your clients and who bring all the revenue and who make all the projects, your treatment with those consultants definitely and should be would be different. So you need to understand my stakeholder groups, what type of activities I am performing, and what type of how to say pressure somebody could build on me. For example, if I speak about, there is one stakeholder group which is called community. Okay, so there are some nature of businesses in which you need to make sure that community is happy with you. I mean, probably your nature of activities which you are performing, maybe you are damaging the environment, or probably your activities are could be not like, but could be detrimental to the society or to the environment. So you keep on doing, keeping, trying to make them happy, the community. But probably you are in some other nature of business. Maybe you are a restaurant owner, or probably you are a school, and you do not provide any activity which actually is hurting or damaging the community. So you say, okay, community comes here. In some cases, community comes here. So you need to understand within your business framework, who are my stakeholders and where do they exist? What is their relative power? We call it stakeholder mapping. So key players are found in segment D. Segment D is where you have high power and high interest, and the organization strategy must be acceptable to them, at least acceptable to them. Stakeholders in segment C must be treated with care. They are capable of moving to segment D. So this is like low interest but high power, the tax department or the government. They are capable of moving to segment D. They should therefore be kept satisfied. So these are the words which you remember and you will use. Strategies, I mean, acceptable to them. These should be kept satisfied, the tax department and others, or maybe other institutional investors. Stakeholders in segment B do not have great ability to influence the strategy because their power is low, but their views can be important because they have got high interest but low power, high interest and low power. So high interest, low power, what could come here? If I see again, where you have, interest is high and power is low. So in many organization you put employees here. Okay, employees in some organization can come here where their interest is high because their jobs are at stake. So they have got a lot of interest because they work, and their family life, everything depends on the job. So interest is high, but power is low because they cannot change. So this is where I would say, the workers in the cement plant, the workers in the cement plant. with low power but high interest. And this is everything is low. Minimal effort is expanded in segment A. Segment A means low power and low interest. Low power, low interest could be my small suppliers. Okay, I have got major suppliers, I've got minor suppliers, I've got suppliers of my raw materials, or I might have suppliers for my office stationery. I mean, these are two different types of suppliers. You cannot treat them same. Okay, you have raw material suppliers, and you have, for example, office stationery suppliers. Don't mix them. Okay, these are two, they have, I mean, if he stops with you, your raw material, your production will stop. But if office, you know stationery or office supplies person is unhappy, you can change him. So you need to understand that who is where. So this is my office stationery suppliers who brings me paper, pens, and files and stuff like that. Problem with stakeholder mapping is that it can be very difficult to measure each stakeholder power and influence because it is subjective. Sometimes a lot of perception issue comes in. Okay, perception. Uh, Probably I think that someone has less power, but maybe they have more power. I underestimate the importance. So it's quite subjective area. The map is not static. Yes, we know. We said that these people, these stakeholders, they keep on moving between different quadrants. The map is based on the idea that strategic positioning rather than moral or ethical concerns. Now, here, just like I said, that if you probably also have noticed that I said that, your if you are a cement plant, your workers are having less power. If 10 people will go, you will bring in 10 people. So this statement itself is probably not very ethical or not very moral, because I was thinking it purely from the business point of view. But if you consider otherwise, I mean, many of you people might be thinking that, employee is an employee, and in all type of organizations, you should give equal importance to employees. If you are a bank, or if you are a cement manufacturer, or even if you are an audit firm, if you have an employee, you should treat them with the same handle them with the same care. This is the moral ground. But if I consider with this Mendelow's model, I would say that my strategic positioning, if I start thinking, I would say if I'm a cement plant, I would care less for my employees. I mean, this is one of the problems with this Mendelow's model. And number four, if there are a number of key players and their views are in conflict, like you have got this D quadrant and you say, this is one which I must keep satisfied, but then you have two or three group of stakeholders there, and their objectives are conflicting, then what you do? So this Mendelow's model does not give answer to this. Mendelow's tell you that whoever comes in D, you try to meet their objectives. The strategy should be accepted to all of them. But the thing is that these are different stakeholders and they might have different uh, objectives, and you can't make all of them acceptable. So then what you should do? Answer is not given in the Mendelow's model. Then you have to make your own judgment. So these are the problems with this Mendelow's model. Then the next topic comes, which is social responsibility.